Hey everyone, and welcome to This Explainer. Today, we are diving into those massive, explosive headlines you've probably seen everywhere about SpaceX's upcoming mega-IPO. But more importantly, we're unpacking what this actually means for your hard-earned retirement money. You've likely seen the news alerts flashing, but we are looking right past the hype today to focus purely on the nuts and bolts of how this directly impacts your portfolio. Okay, so let's kick things off with a question that might actually shock you a bit. What if I told you that you're about to become a SpaceX shareholder, whether you actually chose to or not? I know, it sounds kind of crazy, right? But if you hold a standard 401k or an IRA, this isn't some active choice you're making. It's going to happen automatically. Here's the thing. This isn't about the hype of rockets or satellite internet. It's a structural mechanism. Major index funds are essentially forced buying machines. They're operating without a steering wheel. There's no human portfolio manager sitting there deciding if a stock is a good value today. If a company gets added to the index that your fund tracks, well, the fund literally has to buy it, period. And right now, the providers of those indexes, they are actively rewriting their own rulebooks. Section 1. The Fast Track Index Rules. Let's look at how the fundamental rules of the game are shifting right under our feet to accommodate these modern, massive tech unicorns. Historically, IPOs had to go through this strict seasoning period. A company would go public, and then it had to trade for months, sometimes even years, just to establish liquidity and prove it was stable before being allowed into a major index. But today, index providers are completely ditching that cautious approach. They're creating these new fast-track pathways to push massive private tech giants into your funds in as little as 5 days. They're often waiving previous liquidity requirements entirely just to get them in the door. Now, it's really interesting to see the stark divide between index providers on this issue. NASDAQ and the Russell 1000 are essentially opening the floodgates. They're allowing entry in as little as 5 to 15 days, waiving those liquidity rules, and get this, requiring zero profitability, none at all. But the S&P 500, they're holding the line. They demand a 12-month seasoning period and 4 consecutive quarters of actual positive GAAP profitability. That means real standard accounting profit. And because SpaceX currently lacks this, they are totally blocked from entering the S&P 500 for the foreseeable future. Moving on to Section 2, the math of free float. Before you start panicking about a multi-trillion-dollar company suddenly hijacking your 401k, we really need to take a breath and look at the actual math of how index weighting works. You've likely seen this massive, eye-watering headline valuation for SpaceX splashed across the financial news, $1.75 trillion. When you hear a number that big, it's super easy to assume it's going to just completely dominate your index fund on day one. But here is the secret. Index funds do not care about the total headline valuation. What they care about is the free float. That's the percentage of shares actually available for the general public to trade. And for this IPO, SpaceX is only making a minuscule 5% of its shares available. When you compare the media headlines to the reality, the difference is absolutely staggering. While everyone is fixated on the total market cap, your index fund is exclusively looking at the investable float. They will only weight SpaceX based on that tiny $87.5 billion slice that's actually tradable. So you'll be owning absolute pennies on the dollar compared to what those huge headlines suggest. Let's break this down to put it in perspective for your own portfolio. If you have $100,000 invested, your day one dollar exposure is remarkably small. In a standard 60-40 target date fund, your SpaceX exposure is estimated at just $60 to $120. A total market fund, that gets you maybe $100 to $200. Now, a NASDAQ 100 fund pushes that slightly higher, up to about $700, because of those fast-track low-float rules we talked about. And if you're purely in an S&P 500 fund, your exposure is exactly zero. All right, Section 3, the Mega-IPO Performance Trap. Just because the initial dollar amount in your portfolio is pretty small, that absolutely does not mean there aren't systemic risks lurking in these new fast-track rules. Let's explore the hidden costs here. Experts are pointing out a highly troubling dynamic. When you have this forced, predictable, rules-based buying by index funds, you accidentally create a highly profitable playground for Wall Street insiders. Ben Felix, the chief investment officer at PWL Capital, hit the nail on the head when he noted that index funds end up paying what he calls a shadow tax. Let's trace the actual timeline of this shadow tax so you can see exactly how it plays out. On day 1, the IPO lists. By day 5, the fast-track inclusion is announced. Now, hedge funds and active traders know for an absolute fact that massive index funds must buy millions of shares by, say, day 15. Because this demand is 100% guaranteed and totally predictable, the hedge funds jump in and buy early. They drive the stock price up by roughly 5%. Then, on index inclusion day, the index funds are forced to buy those shares at the absolute peak price from those same hedge funds. Shortly after, around day 30, the hype fades, the price reverts sharply back down, and the passive index fund investor, meaning us, is left holding the bag. It's the inevitable consequence of a rigged game. And historically speaking, buying into these low-float mega-IPOs on the secondary market is just a terrible deal. Decades of data from Professor Jay Ritter proves this point perfectly. Out of 11 comparable large low-float IPOs since 1980, 10 of them severely underperformed the broader market within 3 years. Think about that. 10 out of 11. Statistically, that is a remarkably poor historical track record. To make matters worse, this mechanical buying force forces your index fund to scoop up these companies at truly astronomical valuations. Right now, based on projections, SpaceX would be trading at over 100 times its revenue. 100 times. Compare that to the S&P 500 average, which sits at a heavily grounded 3.1 times sales. It almost goes without saying, but paying over 100 times sales is heavily associated with terrible expected future returns. So, Section 4. What investors should do. Armed with the knowledge of all this mechanical buying, front-running, and historical risk, what are the practical steps you should actually take today? Well, first, remain calm and check your specific funds so you know your real exposure. Second, keep an eye out for lockup expirations. As insiders sell over the next year, the float, and therefore your fund's exposure, will definitely increase. Third, whatever you do, do not panic sell your diversified index funds just to avoid a fraction of a percent of exposure. That completely defeats the whole purpose of diversification. And finally, strongly resist the urge to chase those dangerous private market vehicles that promise early entry. They will bleed you dry with outrageous 4% fees just to get in the door. It's really not worth it. I want to leave you with this final provocative thought. Passive investing has undeniably made building wealth easier and cheaper than ever before for the average person. But as the underlying rules of these indexes bend and warp to accommodate massive mega-IPOs like SpaceX, we really have to ask ourselves, who is actually benefiting from a system that is entirely on autopilot? Thank you so much for joining me for this explainer, and definitely keep your eyes on those fund prospectuses.